Hello viewers and welcome back to Dukascopy TV. I'm Natalie MacDonald. Up next in the studio I'm joined by Ron William of the Swiss Association of Market Technicians. Ron, welcome. Thank you very much for coming into the studio.
Season's greetings to you. I'm happy to be here.
That's great. Now firstly, can you walk us through exactly what the Swiss Association of Market Technicians, or SAMT for short, is and who exactly it's aimed at? What are the group's aims and activities?
Sure. Well, we're the National Society of Technical Analysis here in Switzerland. We've been here for many years, established in 1987, and we basically promote the excellence of analysis of markets per se, psychology within the markets, the trends that exist, and maybe the cycles that persist up until today. We're also affiliated to the Global Society of Technical Analysis called IFTA, the International Federation of Technical Analysis, and we basically organize monthly meetings in each of the trilingual regions, Zurich, Geneva and Lugano. And we also have, of course, an examination to actually try and raise the profile of the actual analysis itself.
Ron, what would you consider as the benefits of technical and fusion analysis? And in fact, firstly, would you mind sort of expanding on what these are for our viewers?
Sure. Well, the buzzword that I'd like to use, which I think has been often used for many years, is fusion analysis. And that's just predicated on using the best of both worlds. Technical analysis and every other type of analysis that helps with the strategy. And so that's the focus that we have here on the chart. Begin with the strategy, the what and the why of what you're investing or trading in, but then also asking your timing questions in terms of entry and exit signals, and that's where technical analysis has an edge. The third most important part of this, this three-legged stool is risk management. And certainly in this environment, all these three points combined provide a very robust strategy.
How then do strategies change then in terms of different market cycles, from passive buy and hold to active market timing and risk management, as you've mentioned?
Well, I mean, it's interesting. If you look at a big picture chart of the last 100 years of stock market history, what we see is that cycles tend to alternate. Each cycle lasts for anything from 16 to 20 years, what we call a long-term secular trend. But within each of these cycles, they create certain market environments which require different types of strategies. Like you said, active strategies for more mean reversion, volatile markets, such as the one that we're currently in from 2000. And we're previously in between 66 and 1982 and before that. And then, of course, the periods in between, the big bull markets, the super bull markets, which tend to be very, very trend-friendly, low volatility, and more passive buy and hold strategies tend to be more popular. The key point here is that technical analysis tends to elevate in terms of popularity and application during these sideways volatile markets, such as the one that we're in. So we're starting to see a great increase of use of technical analysis, both in terms of its application and in terms of people wanting to join our societies to learn more about the subject.
Ron, thank you very much for coming in. Thank you.
Thank you very much.
That's all we've got time for right now, but we'll be back shortly with another exclusive interview for you, so don't go away. Goodbye for now.